actually up 0.4%, and they're up almost 30% this year. You know, there's a column, a Bloomberg opinion column by Parmi Olson that says Facebook investors enter an age of uncertainty. The exposure of poor internal practices will fuel its regulation problems. Shareholders must be starting to worry. That's her column, her opinion. But you do wonder, is it likely that something is going to change substantially in the Facebook model that will impact the top and bottom line?
Well, what's hard to imagine here is that one of these scandals is going to be what ultimately does it, because we have now been asking this question for the better part of 4 years, right? Hey, is the impact that Facebook had on the election finally going to hurt the business? Hey, is Cambridge Analytica finally going to hurt the business? None of these things seem to make a serious dent in Facebook's ad business. And so I've kind of stopped assuming that any type of bad press or scandal is bad for Facebook. What I do think is more serious is some of the privacy things that Apple has been doing around the iPhone and iOS, because that has a direct impact on Facebook's ability to collect data. So until the government or regulators come in and say, we're going to limit the data you can collect and how you use it, I think all these other things are just, it's just bad PR. But everything else, at least for how the business continues to work, seems to be unaffected by pretty much everything that people have thrown at Facebook the last 4 years.
So help us understand what that looks like from a regulatory perspective. I mean, what could regulators do here in the United States or in Europe that could actually have a material effect on the company's business? We have about 30 seconds.
Well, we would have thought a few years ago that, with Europe coming out with all of their new privacy things, that maybe it would have happened then, and it really didn't. So that makes me think that it's going to be really hard for regulators here. But very quickly, imagine if they came out and said, hey, you can't collect certain location data or target people in certain ways. That would be the biggest way that I think you could get to Facebook's business, is by going after their targeted advertising.
It's all about advertising, ultimately. Hey, great to check in with you, especially as those headlines continue to come. Kurt Wagner is Bloomberg News tech reporter on the phone in San Francisco. And as we mentioned, Facebook shares, little change. We were checking them out. They were down 1.7% at one point earlier in the session. But, Tim, call it unchanged, up about 0.2%.
Investors certainly shrugging it off.
Yeah. Well, we know when there's talk of regulatory oversight, there's one thing to talk about it and then one thing to actually implement it or make those changes. And they can take years.
They certainly can, especially when you talk about Washington, D.C. Yeah. Well, speaking of Washington and D.C., let's get a check on the latest world and national news. Nancy Lyons is in the 99.1 newsroom there in D.C. Hey there, Nance.
Hey, Tim. President Biden has rolled up his sleeves again today.
About to get my booster shot and do it publicly.
Biden says he continues to worry, though, about the 23% who have not received their first shot.
We know that to beat this pandemic and to save lives, to keep our children safe, our schools open, our economy going, we need to get folks vaccinated. So please do the right thing.
Biden says he'll be traveling to Chicago this week to talk to more employers as he makes the case for more vaccinations. The CDC is out with results from several studies showing enforcing mask wearing in schools does help reduce the spread of COVID-19. One of the studies showed 113 of the 191 COVID outbreaks that occurred between mid-July and August were in schools that did not enforce mask mandates. Another study examined the first week of school in more than 500 counties. It showed about 16 COVID cases per 100,000 children in schools that require kids to wear masks versus more than 36 cases per 100,000 in schools with no mask rule. History was made in the NFL yesterday when Baltimore Ravens kicker Justin Tucker hit a game-winning 66-yard field goal, the longest ever.
As soon as it left my foot, I knew it was going to have a chance, but I was short from 65 in pregame both ways. For whatever reason, I just couldn't, couldn't get the ball to just go. And thankfully, we found an extra yard and a half that I didn't have 3 hours before.
Tucker beat the old record by 2 yards. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Massar, Tim Stanovic. So if you're headed to Vegas
and you wanted to buy the Cosmo,
not the drink.
Yeah, the Cosmopolitan, excuse me. It's too late.
It's been sold. Well, unless they do another deal, right?
That's true. That's a good point.
Blackstone reaching a deal to sell the Cosmopolitan Casino and a Hotel on the Vegas Strip for $5.65 billion. You and I were just working out exactly what they were all in on and how much money they made.
The sale will reap a total profit of about $4.1 billion for Blackstone. Let's talk a little bit about when they got in, though, and how much they paid. So the Cosmopolitan opened back in 2010. It ran into financial trouble during its construction during the Great Recession. Deutsche Bank built the property for $3.9 billion, but sold it to Blackstone in 2014 for $1.73 billion. Blackstone put in about $500 million in upgrades, it said in a statement.
So, okay. So
$4.1 billion.
Not too shabby, it seems. And that includes cash flow from operations at the property. The Wall Street Journal reporting that earlier today, citing a Blackstone letter to fund investors. MGM Resorts, by the way, they're going to take over operations of the Cosmopolitan, while a partnership between the Chung Family Trust, Stone Peak Partners, and Blackstone Real Estate Income Trust are buying the real estate.
Wow.
So they're going to own the real estate underneath it.
Yeah, Blackstone tried previously to find a buyer for the property at $4 billion or more. Prices, though, for Las Vegas casinos have continued to rise despite the pandemic as real estate investment trusts purchase properties and split costs with management firms. A different story certainly playing out for those big-name casinos that have large operations in Macau, though.
Yeah, this is fascinating. There is a lot going on. We know the China-Macau thing is certainly a very specific story. Casino companies, by the way, have been shedding real estate, often holding on to the management of the properties. Apollo is buying the Venetian Resort Complex in Vegas for $6.25 billion in a partnership with VC Partners, which is a REIT. So there's a lot of movement going on right now. And I think typically some of these private equity firms, they buy something and they do look to make that exit, right? That's how they make money for their investors. So they've got to do it within a certain time frame.
Check out this story. It's available at the Bloomberg Terminal and at Bloomberg.com. This is Bloomberg Radio, and this is Bloomberg Business Week.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Somewhat divided today. On the positive side, we have energy, financial, and material shares moving up, stocks that are generally considered to be economically sensitive. But we are also dealing with this move up in long-term interest rates, and that has put a dent into the high-tech arena. Information tech as a group is down about 1% within the S&P 500. But we are also seeing a lot of weakness among healthcare stocks, with the S&P Healthcare Index down more than 1.3%, and that is leading the broader market lower, with the S&P down about 0.1%. On the positive side, yes, the Dow is higher by 0.3%, and the Russell 2000 also doing well today on the upside with a gain of about 1.9%. But again, the weakness in technology leading the NASDAQ composite down about 0.4%. Keeping a close eye on crude oil, WTI now in the extended session, 75.25. So we're up something greater than 1.7%. We know the market's been tightening generally. Inventory levels are very low, and we're dealing now with this global energy crunch. Goldman Sachs was saying earlier, Brent crude could hit 90 a barrel as the market is in bigger deficit than many realize. Brent right now, 79.30. And again, that 10-year Treasury, 1.47%. I'm Doug Prisner. That's your Bloomberg Business Flash.
All right, got it, Doug. Thank you so much. This is among our most read stories on the Bloomberg today. It's a company we talked about actually last week, Zillow, known for its addictive real estate listings. We've all been there scrolling through. And as Business Week has written before, the company has moved deeper into the world of home buying, Tim, and now it is involving Wall Street more deeply as well.
Well, let's talk about it with Joel Weber, editor at Bloomberg Business Week. He's with us in the Bloomberg Interactive Brokers studio. Also joining us, Noah Buhire, real estate reporter at Bloomberg News, joining us on the phone from Seattle. Joel, for people who aren't familiar with it, what is iBuying?
Okay, so this was a story that we actually covered as a cover story when it came out a couple years ago. Zillow will actually go into a market. The Phoenix area is one that gets talked about a lot, and they will actually, not unlike what Carvana will do with cars, they will actually be a party that will buy a house from you. So say you want to buy a house or sell a house, Zillow will actually be in place of a realtor, right? That's a recent phenomenon. It's a volume business, really, and what we're really interested in this story is the money behind that, because it's all been a little shrouded, and it turns out that it's pretty big, and with there's more opportunity here that could, in theory, could end up going some places that could become problematic. So Noah, what do these numbers look like, and why should we be attuned to them?
Yeah, like you said, Zillow, along with a handful of other companies like Opendoor and Redfin, will give you one of these instant cash offers for your home if you want to sell it. And this really started out quite small a couple years back, but it's grown very quickly. In the second quarter, the biggest companies in this space bought something like 15,000 houses around the U.S., or were basically 1% of transactions, which I think would surprise a lot of people. And the way that they've managed to do this, as you alluded to, is with a lot of credit and debt that they've got from elsewhere. So they started out with credit facilities that banks and other lenders would arrange for them. But what's so interesting now, and why we wanted to write the story, is that Zillow has done one bond deal where they've basically securitized homes that they've bought but not yet resold. And they're in the process of doing a second bond deal, and this is all within a matter of a month or two here. So Wall Street is very much getting drawn more into this, and if you listen to what these companies are saying about their projected growth, I mean, this is the fuel that is going to enable them to scale and become much more of a force in the U.S. housing market.
Wall Street interested in housing. Where have I heard that before? This story is fascinating. Tell us about the volumes that you're seeing by some of the major players, Zillow, OfferPad Solutions, Opendoor, and how it's getting ready to explode as you report.
Yeah, look, I mean, these companies have thrown out numbers like, OfferPad is saying it could eventually buy 70,000 homes a year. Open Door, is looking to capture 4% of all home sales in 100 markets. So, look, the ambitions are big. That's been out there, and we wanted to put that all together for folks so they understood what those ambitions are. But the only way they're going to get there is if they are able to tap debt markets and get investors to give them the money to be able to do this.
So as a consumer, I'm incentivized to do this because real estate transactions are just headaches. There's like lawyers and other parties' lawyers and appraisals, and it just gets really messy and drawn out. Zillow basically expedites all of that, right? So what could possibly go wrong?
Well, look, on a certain level, what these companies are doing is saying that their algorithms can effectively guess or predict short-term price fluctuations, because they don't want to buy a house and then suddenly have that house plunge in value, so that when they turn around to resell it's worth less. I mean, that's a recipe for losing money. So really, I think the biggest risk here is that these companies have been buying their homes over the last couple of years, which has been an incredibly beneficial market, an easy market in terms of home prices. They just have tended to go up over the last 5 years. So the question is, what happens and how accurate are these algorithms, and how well have these companies calibrated their purchases if we run into a situation where home values start dropping?
What about how this has been received? Because there have been some examples recently of realtors going viral on TikTok that have accused iBuyers of coming in and raising the price of housing and also decreasing supply as a result of this.
Yeah, well, I think you need to look at the response in a couple of different ways. On the one hand, investor response to the first Zillow bond was tremendous. I mean, they sold $450 million in debt, and it was many times oversubscribed. So Wall Street and investors in general seem very eager to get exposure to the housing market in this way. These are, Zillow and the other iBuyers aren't holding these homes on their books for very long. The idea is to buy them, do some light repairs, and get them listed and sold very, very soon thereafter. As to consumers, I think there's a lot of worry out there. We're in an extremely low inventory moment right now in the market, and as you said, there was a TikTok video that went viral last week that insinuated that bad things were going on here. I think it's still too early to tell what exactly the impact is that these companies are having on the housing market. There is, an argument to be made that they're increasing liquidity, and that homes that might not have gone on the market are going, are becoming available in part because they're making it so easy for sellers to get cash and move on.
I also just do wonder real quickly, 30 seconds here, that when it comes to Zillow and its exposure to housing, when we start to look at it as, financially when it reports earnings, I mean, is it becoming a bigger and bigger part of the company's top and bottom lines? So that if something comes undone, we have to be wary of that? Just quickly.
Well, certainly that's where the company wants to go, but their main business is still very much helping people find homes and helping agents find customers who want to buy and sell homes.
I don't know, Wall Street housing?
Algorithms.
Zestimate. Everyone knows about their Zestimate.
That is so true. All right, check out that story. Noah Buhire wrote it. He's real estate reporter at Bloomberg News, on the phone in Seattle. Jill Weber, editor at Bloomberg Business Week, right here in our Interactive Broker studio. Coming up, we're going to hone in on China. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It is 3 p.m. on Wall Street. We have an hour remaining in the Monday session. A mixed picture right now for the equity market. I'm Doug Krisner at Bloomberg World Headquarters in New York. We're seeing strength in many economically sensitive stock groups, areas like energy and financials. Even smaller cap shares are rallying. We've got the Russell 2000 up about 1.9% right now. But a move up in long-term interest rates has really rattled certain areas of the equity market, particularly big cap tech. And that's weighing on the NASDAQ composite, which is off about 0.4%. In the broader market, it's healthcare leading the S&P 500 down about 0.2%. The S&P Healthcare Group is weaker today by about 1.3%. We've had a lot of Fed speak. New York Fed President John Williams was saying earlier, assuming the economy continues to improve as he expects, a moderation in the pace of asset purchases may soon be warranted. We also heard from Fed Governor Lael Brainerd saying the labor market may soon meet her yardstick for scaling back those asset purchases. And Brainerd said the Delta variant could raise upside risk for inflation as supply constraints seem to last a little bit longer. As long as we're talking about the Fed, Boston Fed Bank President Eric Rosengren will retire this week. This is due to a long-standing kidney condition. He is a notable hawk, and analysts are saying he is one of the higher dots on the plot. Now, the Boston Fed Bank is saying the search for his successor is underway. Facebook is pausing work on rolling out its Instagram Kids site earlier this month. The Wall Street Journal reported internal research conducted by Facebook finding Instagram is harmful for a sizable percentage of young users, especially young girls. And we have Facebook shares right now higher by less than 0.1%. Against that, 10-year Treasury is at 1.48%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
So yeah, as always, there seem to be a few headlines out of China catching our attention. China's embattled tech tycoons lining up to pledge their support for President Xi and his common prosperity policy and all of the regulatory onslaught that we've been seeing, especially when it comes to the digital sector. That happened at the country's annual internet conference. A lot going on. Huawei, we saw that official being released. So let's get to it. What really matters? Bloomberg New Economy editorial director Andy Brown is back with us, former China editor at the Wall Street Journal. He's in our Interactive Brokers studio. Huawei, Evergrande, I mean, I feel like the list goes on, and it grows every day, Andy.
Yeah, you got to wonder how many shocks this economy can take without something going wrong. And you started off talking about the tech titans. Elon Musk and others were there in Wuhan, making very clear to the Chinese authorities that they are totally on board with their data policies, and they pose no threat whatsoever in that score. They understand that China is in a very fragile place now, and foreign investors are in the firing line. But, you know, the most immediate threat to the Chinese economy is from Evergrande. This is the the most indebted real estate company in the world.
Massive, right?
Well, I was really interested to read your column on Saturday, because the narrative that emerged in the last week is that this wasn't another Lehman Brothers moment. This was something that was contained not just to China, but and many people were even insulated from that. So to pick apart that argument for us.
Yeah, you know, in many ways, you can look at Evergrande as being a microcosm of the entire Chinese economy. Massively over-leveraged, having taken an enormous bet on the Chinese real estate and infrastructure sector. The bet being that demand for apartments in China is inexhaustible, and therefore property prices can only go up and up. Now, of course, they have been doing that for the last 10, 20 years, but there are big structural forces at work now. And two of them, which I identified in this column that I write, is number one, the Chinese labor force is shrinking, okay? That's a real problem, given that it's workers who are the primary buyers of homes in China. And number two, the cities where Evergrande operated, these are third and fourth tier cities, the smaller cities in China, these are the cities where the great tides of internal migration ended up, right? Farmers leaving the land, going to the cities. They weren't allowed into Beijing, Shanghai. They flooded into these third, fourth tier cities. Those cities are now shrinking. The Paulson Institute, which is really good on these issues, reckons that 60% of the Chinese urban population are living in shrinking cities. Now, what does that do? Not just to Evergrande, but to all kinds of other property developers who have been betting on exactly the same market.
And Chinese who've been betting on real estate as well.
Yeah, well, right, exactly. So 80% of Chinese households, or 80% of Chinese household wealth is locked up in real estate.
Andy, in the Saturday column for New Economy that you wrote, you said Beijing has seen all this coming and is rightfully alarmed. You talked about a controlled explosion. I mean, they wanted farmers to migrate to the cities. They wanted to have these cities. They wanted to spend on infrastructure, right? I mean, so they can't be surprised by it.
Well, the game is up. We're seeing the beginning of the end of this real estate boom. And don't forget, it was the real estate, the sales of land to local governments that paid for the infrastructure. So you had this virtuous cycle. So, the local governments use the land sales, they invest in roads and sewerage and bridges, all this kind of, and other physical plant. And that then attracted more people to come to their cities and attracted businesses and tax receipts. All that is now unwinding. In fact, it's going into reverse. So that game is over, and the government clearly recognizes this, and they're worried about the debt. And so they wanted to send a signal to real estate companies right across China, you've got to get this debt under control, right? They don't want a collapse. The question is, though, whether or not they can avoid not contagion through the financial system. They've got that pretty much under control. Different types of contagion, which is going to show up in much, much slower levels of growth.
Which to me is the big takeaway that you've talked a lot about.
Yeah, talk a little bit about that, because you mentioned washing machines in this column. You mentioned other elements of the economy that are affected. So what's the next shoe to drop? What should we be watching?
So real estate spread wealth far and wide in the Chinese economy. You bought an apartment, you filled it up with air conditioning and washing machines, other appliances. Car sales in China were 1-for-1 correlated with new apartments, right? So where were these places built, these new housing estates? Of course, out in the suburbs.
You needed a car, right?
You needed a car to get there. So, once, I mean, I won't say it's like taking the pin out of a grenade, but I mean, if property is no longer going to be driving growth, where is consumption in the long going to come from?
Well, and I also think we have to rethink, and I think you write this about, is China really an emerging market anymore? What is it? How do we think about it, certainly as investors or economists or what have you?
Well, we tend to think of emerging economies as being high risk but high growth economies, right? Well, I think it's quite likely that what you're going to start seeing now is growth grind slower and slower and slower, and it's going to get for this. And the price is foregone growth. Japan had a decade of lost growth.
Is the uncertainty here being reflected, in your opinion, properly in the market?
I think the market seems to be focused on the technicalities of the potential financial contagion. And if you ask me, that's really the wrong thing to worry about. In China, pretty much all the debtors and the debt is all in yuan. The state runs the banks. It can basically take apart these private conglomerates and say, well, you give to this person and so on, and unwind it all in a fairly orderly way. The contagion, I think, is going to come through the macro economy.
Right. I mean, think about commodities, or if they're not building like they were, just how that trickles through the markets.
That's for the rest of the world. A China that isn't investing the same in real estate is going to be buying less iron ore, fewer metals. Australia should be worried.
Andy Brown, thank you as always. Andy Brown is our Bloomberg New Economy editorial director. Check out his column every Saturday on the Bloomberg Terminal and at Bloomberg.com.
Let's head to Washington, D.C. for a check of the latest world and national news with Nancy Lyons in the 99.1 Newsroom. Hey there, Nance.
Hey, Tim. House Speaker Nancy Pelosi and the White House are working to close a split in the party that threatens to blow up President Biden's economic agenda. Bloomberg's Washington correspondent Joe Matthews says Pelosi has pushed a vote on infrastructure until Thursday.
Nancy Pelosi does not want surprises. She's seen this movie before, remembering the Obamacare debate when she was still holding that gavel more than 10 years ago here. She will not bring legislation to the floor unless she has the votes. So that, at this moment, is something she does not have and will need to do some serious vote counting in the next 4 days.
Joe Matthews says progressives are insisting on progress first on the bigger social spending bill before taking a vote on infrastructure. President Biden says he's an optimist and believes they'll get it done. A judge has granted the unconditional release of John Hinckley Jr., the man who tried to assassinate President Ronald Reagan in 1981. And he will get that unconditional release by June of next year. He was freed from a government psychiatric hospital in 2016 and has been living under court supervision. Barry Levine is Hinckley's attorney.
He wishes he could undo that act. It's the nature of regret. It's being unable to undo that which you did. It's what regret's about. He can't do it. He can't undo it, but he wishes he could.
Levine says Hinckley is now free of mental illness. The unconditional release terms include a final 9-month period of observation required by prosecutors. And also, we're hearing that jurors in R. Kelly's sex trafficking trial say they have reached a verdict. We do not know yet what that verdict is. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. You are listening to Bloomberg Business Week on this Monday. Tim Stanovic, Carol Mass are here. This story by our Debbie Wu really ties in a lot of things. We're watching China, we're watching tech, we're watching the global economy, we're watching the energy crisis.
Yeah, I wish I would have had time to ask Andy about this because this is just a fascinating thing to see. The iPhone assembly operations in China are beginning to reduce their energy consumption because of a sudden power crunch in the country, which has triggered government-imposed curbs on a range of businesses.
This is wild. Pegatron Corp, it's a key partner for Apple, one of the assemblers of its iPhone, saying today that it's taking energy-saving measures to comply with local government policies. Still, the firms responsible for reducing the Apple handset have avoided drastic cutbacks in production so far and appear to be getting preferential access to energy in order to keep operations going, at least according to people familiar with the situation. But listen, this goes and this plays into a story we're going to get into in just a moment, the Bloomberg Big Take, about what we're seeing in Europe specifically, the energy crisis. We've been looking at the UK and elsewhere, specifically not having all the power they need and shutdowns of facilities, and whether or not that could be broadening more globally.
Yeah, and the fact that we're getting into the colder months in many parts of the world is a sign that things could get even more expensive. Let's talk about China, because curbs on industrial energy use have been imposed across several provinces. That includes the economic powerhouses of Guangdong and Jingzhou, as Chinese officials pursue President Xi Jinping's carbon-neutral push and react to escalating coal and gas prices.
That's the other thing that's going on. We saw President Xi, right? We heard from him, certainly at the UN General Assembly, many world leaders, and China specifically, and President Xi talking about no new internationally financed, right, coal-powered plants, but definitely looking to reduce China's imprint on the climate.
As if,
why are you smiling?
Because it's like if you're Tim Cook right now, you're like, okay, chip shortages aren't enough, and look, Apple ships its stuff by plane a lot of times, so it doesn't necessarily have those other supply chain issues, but still, you got to be like, okay, what's next?
And this is why you wonder if you'll see more domestic supply chains.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We have just about 42 minutes to go until the closing bell. A mixed picture for the equity market. Let's get you the very latest on the price action. Bill Maloney is at the Bloomberg Macro Squawk Desk. Hi, Bill.
And good afternoon, Doug. That's right. U.S. stocks trading mixed today, with the Dow currently up 122 points. S&Ps are down 3, and NASDAQ pares losses to a minus 50. The U.S. 10-year yield traded to 1.51%. Gold is little change. Transports jumped 200 points. And among the main 11 SB sectors, leaders were energy and the financials. Healthcare and tech led to the downside. Leaders to the upside in the Dow Inc. and JP Morgan, while Salesforce and Microsoft were under pressure. And in other news, Amazon's price target was cut over at Morgan Stanley, and Wells Fargo was sued by the Justice Department over Forex services. In deal news, Blackstone is selling a Las Vegas casino for $5.65 billion, and wrapping things up, SeaWorld hit a record high. Live from the First Breaking News Desk, I'm Bill Maloney. Doug.
All right, Bill, thank you. And from the Bloomberg Terminal news from the Brazilian mining giant Vale, the company is saying 39 employees are stuck at its Totten mine in Sudbury, Ontario, in Canada. Now, this incident especially kind of connected to a problem with a shaft in a mine that occurred yesterday afternoon. The company says workers are safe, and the company is mobilizing an exit to the underground mine after the conveyance for transporting employees was taken offline. We'll track this story for you throughout the afternoon here on Bloomberg. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Dougie, thank you so much. Doug Krisner there. Catch him on Bloomberg Daybreak Asia tonight at 6 p.m. Wall Street time. Well, let's get to the Bloomberg Big Take today. It's about Europe's energy crisis. Tim, it's coming for the rest of us.
It certainly is. Rachel Morrison is an energy reporter at Bloomberg News. She joins us on the phone from London. As you mentioned, Carol, it's today's Big Take, the one story from around the world that needs to be on your radar. Millions of people around the globe will feel the impact of soaring natural gas prices this winter. Rachel, thanks so much for joining us. Paint the picture of what things are looking like when it comes to natural gas right now, especially as we enter those colder months.
Well, gas is an international market, and what is hitting one side of the world will, before long, affect other markets. And you're right, as the temperature starts to drop, as the winter heating season begins, we're going to see everyone going after the same cargoes of liquefied natural gas, the same pipeline supply that coming from Russia that everybody wants to get their hands on, and that's going to push prices up. And we saw in January this year, when the weather got really cold, that the prices in Asia, in Europe, and the US, they spiked everywhere. So it's not going to be Europe in isolation. If we get a cold winter, we're going to see the same spreading.
Rachel, how did we, in so many ways, go from glut to shortage?
Yes, thank you. I thought this was like, my parents put in a new washer dryer and it's powered by natural gas because that was, 2 years ago. That's what they told us to do.
It's, as I mentioned, in January, we had that really cold spell. I know it's always hard to remember after the summer, but it was very cold then. And then people didn't have the chance to refill storage during the summer. Demand stayed high and prices just haven't dropped. So we've seen this building. We've seen it building up in the markets since the end of last winter, and that's really put us in this situation for this winter where there may be a bit of a supply crunch, or if you are going to get gas, it's going to be at a high price.
So you're saying that the supplies are dwindling, or is it a case of the supplies are there, but it's not so easy to get it to everybody who needs it?
The supplies are fewer than they normally are, but because we don't have as much in storage in Europe as we normally do, you have the extra demand of people trying to fill those stores. So those are much lower than they normally are at this time of year, which is making everyone afraid for winter that there aren't going to be enough supplies in storage to call on, which is then going to push up support and demand for the supplies that there are. So it is not a single factor that makes the demand more. It's the fact that there's not any gas in storage.
What about when it comes to renewables like wind power or, not a renewable, but nuclear, which is it has been common in Europe?
Yes, it's really interesting because one of the things that's been pointed out by policymakers is that these high gas prices really highlight the need to continue to build out more renewables. But while that's true, those sources are intermittent, and we do need something to back it up, which in a lot of cases in Europe particularly is gas. So we're sort of caught in this web of trying to get off gas, but finding it difficult. And this crisis is really showing how dependent Europe and other places still are on gas, and it's not going anywhere.
Well, and what's interesting too, we think about heating our, homes, we think about cooking our food, but it's also something that's important to fertilizer producers. And this story over the last couple of weeks has really caught my attention, that if they don't have what they need, you do think about their ability to feed people in Europe.
Yes, the producers who are cutting back, curbing production because of high gas prices, that is a concern when it comes to the knock-on effect throughout the economy. So, as you mentioned, food shortages, and we've seen the CO2 shortage in the UK, which the government has now moved to try and alleviate, and that's things that you don't think of, refrigeration, stunning of animals. So it has knock-on effects. You're right, it's not just turning on your heating at home. It could cause all kinds of other disruption, which obviously people don't want at any time, but particularly not in winter.
Is it kind of a perfect storm? I'm looking at this great Bloomberg Big Take that's on the Bloomberg terminal. It talks about Chinese factories have to contend with widespread power shortages. Global prices for steel and aluminum will jump. And they say to make matters worse, the country is also grappling with a coal shortage. In Brazil, the lowest flows to the Parana River Basin in almost a century have slashed hydropower output, forcing utilities to rely more heavily on gas. I mean, it just feels like it's coming at all angles.
Yeah, what a list. Yes, the perfect storm is a phrase I've heard lots of analysts using about this. And I think when we throw into the mix the potential for cold weather, that's really what is getting people worried. Governments, not just traders and companies, but that's what's really going to push this into something that we remember for decades, is if it's going to be cold.
It's just staggering. A great read, and we really appreciate getting some time with you. Rachel Morrison, she's energy reporter for us here at Bloomberg News, and kind enough to, it's getting a little late there in London, so thanks for sticking around the office or jumping on the phone from your home. She, of course, was joining us from London.
Yeah, I mean, I think the big question is how cold is it going to get, and how much more are people going to have to pay, and then what the repercussions are from that.
Right, and you think about the inflationary impact. You also think about if you're paying more for that, you don't have money to spend on other things.
Is it just me, or is everything supply constrained right now?
I'm crawling under my rock right now.
Yeah. Ed Ludlow is going to be joining us from the Port of LA later this show.
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
I am starving.
Oh, you got an hour and a half until you can get some food.
Kind of want a cheeseburger with fries.
All right, noted.
You know what I also want?
What?
Chart of the day.
Oh, I'm with the song of the day.
Yes, indeed.
Well, fortunately, in just a few minutes, Dave Wilson is going to bring that to us. In the meantime, let's get a check of the trading day with Doug Krisner.
What, no drink of the day?
Oh, well, yeah, I guess it's not too early.
I'm just asking.
Your day's just getting started, though, at
really?
6 o'clock
Okay,
p.m.
well,
Boy, Krisner.
It's 5 o'clock somewhere, I think, as the saying goes, right? The equity market is trading mixed right now. We also have to report a move up in long-term interest rates, and this is having a negative impact on a lot of technology stocks because it puts a very bright light on the valuation story. But on the positive side, it's energy, financials, and even small caps, which are rallying. The Russell 2000 up about 1.8%. Dow Industrial Average better by about 0.3%. Weakness among real estate and healthcare leading the S&P 500 down about 0.1%. NASDAQ Composite off about 0.3%. Facebook is planning to pause work on rolling out an Instagram Kids site. Earlier this month, you might recall, the Wall Street Journal had a report on an internal research paper conducted by Facebook. It found Instagram is harmful for a sizable percentage of young users, most notably teenage girls. Shares in Facebook, though, better by about 0.6%. Today, we had Morgan Stanley cutting its price target on Amazon. The firm says the online retailer's profit could come under pressure as the result of a rising headcount and higher wages. Amazon shares right now weaker by about 0.4%. 10-year Treasury, by the way, yielding 1.48%. I'm Doug Krisner. That's your Bloomberg Business Flash.
Thank you so much, Doug Krisner. This is Bloomberg.
No, it's not.
I don't know who it is. Who is it?
It's a band out of New Jersey.
Oh, he looks at me with such disdain, New Jersey
Your
girl.
home state.
There you go. Which would become later known, for songs like "Celebrate Good Times, Come On."
I love Celebrate. Wait, not Casey. No.
But the K is right.
I have to tell you, the first bar I went to, that was like the song that was always playing. I can't even say that. Okay, go ahead.
Kool and the Gang.
Kool and the Gang. Celebration is such a great song.
Absolutely, and that's why it's such a staple at weddings. In any case.
That's so true, right?
But the song we're referring to here is Open Sesame.
Okay.
And it all ties into the story of Alibaba and the 40 Thieves.
Oh, nice.
Okay.
Right? Because that was the command. That's how Alibaba got the hidden treasure. Well, we've seen a lot of Alibaba Group Holdings treasure kind of taken away, you might say, by stock investors lately. And so what the chart does, and it's based on one that I saw on Twitter Friday from Charlie Bolello over at Compound Advisors, is compare the market value of Alibaba with Walmart, world's biggest retailer by sales. Now, Alibaba never came close to Amazon.com, so the Walmart comparison is sort of more relevant, you could say. You go back a year, and Alibaba was twice Walmart's value. In fact, it got to almost $860 billion last October. On Friday, though, Alibaba fell below the market value of Walmart.
Big move.
We're talking about a 54% plunge from that peak. So, as it happens, things have kind of turned around today, and Alibaba's up and Walmart's down. So,
You had already made the chart.
Yeah, exactly. Plus the fact that, none of these kinds of moves are ever kind of nice and neat. But the fact that it even got there in the first place tells you how much the effects of the Chinese government's efforts to rein in technology companies have, played a part in bringing down Alibaba's value.
Check this chart out. It's available, of course, on the Bloomberg terminal. Dave will tell you how to get it on email. But the drop from close to almost $900 billion in market cap down to $400 billion.
Absolutely. That's $500 billion in market value basically gone.
So I guess the question is, Dave, is this where investors get back in and say, okay, it's gonna be a long slog higher, but we believe it'll get there?
Well, there are some, no doubt, who will do that, and it may explain why the stock's up today. Right. Nonetheless, though, I mean, considering all the moves the Chinese government has made over the last several months, you have to wonder whether it's over. And, if it's not, what happens to Alibaba next?
Well, we talked with Andy Brown, and you did have those big tech, Chinese tech CEOs or senior leaders at an internet conference over in China basically being like, all right, we're all in. We're backing you, President Xi, when it comes to common prosperity and some of the changes you want to be. So you do wonder, are they now playing with these changing rules, and does that make it a friendly environment for them going forward, or does it mean a different business equation going forward, and maybe these pullbacks are going to be more reflective of their future value?
All good points. Certainly Alibaba has been part of that move to at least placate the government in terms of its own actions, but you do have to wonder if business is not quite going to be as lucrative as people had anticipated just a year ago. And so that comes into market value, no question.
I like it, Lost Treasure, the whole Alibaba theme, and the song.
Wait, the song was called what?
Open Sesame.
Okay, there it is.
Cool in the Gang.
Yeah. You're not going to forget that one at the next wedding.
I feel so. No, it's one of those songs. It's up there with "We Are Family" and.
Right.
You're
right. Open Sesame was early on before it became much more of a pop sound out of Kool and the Gang.
Got into that first bar with my sister's license. They were paper licenses. You could erase.
Careful. I don't know what the statute of limitations is on that.
All right, stock of the day. What do you got for us, Dave?
I've got R.R. Donnelley and Sons, the longtime commercial printing outfit. The ticker is RRD. For the last couple of years, they've been dealing with an investor, Chatham Asset Management, now has about a 15% stake in the company and has been pushing for changes. Well, the latest push came today. They released a letter that they sent to the board of Donnelley asking for a new chairman, changes on the board, cost cuts, a strategic review. And they said, if we don't get what we want, we're going to start a proxy fight, in so many words.
Like a toddler.
Yeah, absolutely. So, and in response to all that, Donnelley's shares are up 12%, and they're headed for their biggest gain in more than 6 months.
It's a $4.91 stock, though.
It is true.
Just a little perspective there.
Yeah, $360 million market cap, but year to date, it's up close to 120%.
Yeah.
Yeah, so which when you have low stock prices, you get these outsized percentage moves. That's one example.
And when you have activist investors, right, the stock gets moving.
Yeah, it often does. That's true.
All right, find Dave's stock of the day at 4:15 p.m. We can find it, what, Dave? At The One Dave, on LinkedIn, and on Twitter.
Yeah, well, that Twitter's at The One Dave. Don't forget Facebook.
Thank you very much.
All right. Well, let's check out the latest world and national news with Nancy Lyons in the 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. After decades of accusations, R&B singer R. Kelly has been found guilty of racketeering and 8 violations of an anti-sex trafficking law. Over the 6-week trial, prosecutors successfully laid out a scheme in which they said Kelly was the ringleader, recruiting women and underage girls for sex. Witnesses described the charismatic singer as a calculated and controlling predator. He could face decades in prison. Well, President Biden, as promised, has rolled up his sleeve to get a booster shot of the Pfizer vaccine, and he did it before the cameras.
The president said he hadn't experienced any side effects from his previous vaccinations.
Boosters are important, but the most important thing we need to do is get more people vaccinated. The vast majority of Americans are doing the right thing. About 23% haven't gotten any shots. That distinct minority is causing an awful lot of damage for the rest of the country.
The president said he'd look for more ways to require vaccination, and he'll travel to Chicago this week to make the case to more employers. In Washington, Irv Chapman, Bloomberg Radio.
President Biden is leaning on congressional Democrats to pass his big agenda items. White House Press Secretary Jen Psaki says the president is anxious to push the items over the finish line, though a series of phone calls and personal meetings. She says all lawmakers should want these bills to pass.
Roads, rails, bridges, they are not Republican or Democratic. They They are initiatives. They are improvements the American people want. People want improvements to childcare. They want their costs cut. They want the tax system more fair.
Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts.
All right, Nance, thank you so much. So we've been talking about this story, and rightfully so, a lot here at Bloomberg. Craig Torres writing about it. We've had our team checking in with our own Mike McKee, who covers the Fed. Federal Reserve Bank of Boston President Eric Rosengren retiring this week due to a health condition, a decision that also follows revelations about his trading activity last year.
He'd served as head of the regional Fed bank for 14 years, and he was due to step down by June. That's when he would have reached the mandatory retirement age of 65, so this retirement certainly coming a good time sooner than that.
Boston Fed, though, citing a long-standing kidney condition, announced the news in a statement today. It said the search was underway for a successor. Rosengren's resignation, an opportunity to get a more diverse set of views on the Federal Open Market Committee, the FOMC. This, according to Julia Coronado, president of Macro Policy Perspectives. She goes on to say it really should be a priority, but have to say that news of his early retirement on Thursday really coming in the wake of embarrassing disclosures about unusual trading activity last year by Eric Rosengren and Dallas Fed Chief Robert Kaplan. That was among the questioning of Fed Chief Jay Powell in that latest Fed meeting last week.
A couple questions about that, and the Fed chair was not happy about that. The revelations prompted Fed Chair Jay Powell to ask staff to examine internal ethics rules around financial holdings and activities by senior Fed officials to identify, quote, ways to further tighten those rules and standards.
Yeah, exactly. No one on the FOMC is happy to be in this situation, to be having these questions raised. It's something we take very, very seriously. This is what Jay Powell said on September 26th after that Fed decision. I'm determined that we will rise to the moment and handle it in ways that will stand up over time. But again, this goes to disclosure, and I think it's safe to say that everyone holds those Fed officials above and beyond everyone else when it comes to this kind of stuff.
Yeah, Kaplan was a former senior Goldman Sachs executive, and it showed that he had multiple $1 million plus transactions last year as the U.S. economy was convulsed by COVID-19.
There's more in this story. Feel free to check out Craig Torres' story at Bloomberg.com or on the Bloomberg terminal. This is Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We have about 13 minutes or so until the closing bell for the Monday session. Equities continue to trade mixed. I think one of the key stories of the day is the move up in long-term interest rates. That has essentially put a bright spot on some of the valuations where mega-cap tech is concerned. One of the reasons that we're seeing a little bit of weakness in the NASDAQ composite today, down about 0.4%. But on the positive side, many economically sensitive stocks within energy and financials moving to the upside. And look at smaller cap firms. They are trading to the upside as well. We've got the Russell 2000 up about 1.7%. The Dow ahead 0.3%, but weakness in real estate and healthcare leading the S&P lower now by about 0.2%. Talked a moment ago about that spike in rates. Yes, earlier in the day, the 10-year briefly traded with a yield that was slightly north of 1.5%. We haven't been there since June. We've settled back a little bit, not by much, 148. Crude oil rallying in New York. We're up about 2% now in the extended session, 75.40. We've been talking about a very tight market given the global energy crunch. Goldman Sachs is saying that Brent could hit $90 a barrel by the end of the year. We're nearly there now, 79.40 on Brent crude. Goldman was saying the deficit in the market is larger than many realize. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug Krisner, thank you so much. It is 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
Despite years of fading popularity, the party that backs Russian President Vladimir Putin won well over 2/3 of the seats in the country's new parliament. An electoral system that punishes a divided opposition helped, but so too did bans of so-called extremists, doppelganger candidates, pliant Western tech companies, and electronic voting, which delivered surging support for Putin's party just as key races in Moscow appeared to be going wrong. Social media footage of ballot stuffing and reports of violations abounded, despite official denials of widespread wrongdoing. The Kremlin hopes the results will project popularity. Don't be fooled. Unable to answer concerns over a lingering pandemic, rising prices, and shrinking real incomes, the Kremlin chose to emphasize control over credibility. It's a sign not of strength, but of the regime's underlying fragility. Putin fears the consequences should he loosen his grip. Russia in 2021 is a darker place than it has been in decades, and the rest of the world needs to take note. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
10 minutes left in today's trading session, 9 minutes. Forgive me as we were counting down to that closing bell. With us is Francis Oh, Managing Director, Head of AI ETFs at Kraft, on the phone from Seoul, South Korea. Francis, it's early in the morning there. Thank you so much for staying up for us. We really appreciate it.
How's Tuesday? That's what I want to know.
It's Tuesday, right? What's Tuesday looking like?
Thanks for having me. Yeah.
Well, it's good to have you here.
So,
go ahead. Give us. Just let's start macro perspective. What are you seeing when you look at the marketplace right now?
Right. I think there are a lot of things that are moving parts in the market right now. Like in market general, like in 2021, the stock market has been enjoying pretty much like a Goldilocks type of situation, but it's still very fragile. Like the Delta variant has been concerned for the market during the August to early September. Now there's an uncertainty in the policy, not only in the United States and China is a lingering concern in the market right now. So we'll probably see a little more volatility in the market, especially like a VIX index. It has been, it's bottoming in the middle of June this year, but we start to seeing the VIX 50-day moving average start to forming an upward trend since that. So this kind of risk are many parts of it is a known risk, but probably so may not bring down the huge downside risk in the market, but may affect some of the quite badly to the investment sentiments.
Francis, I'm wondering how you're reading into the move in bond yields that we're seeing right now with the 10-year note going above 1.5% for the first time since June. What's the signal that's sending you?
Right. I think these are probably the very natural response from what we have been seeing in the COVID-19, the situation changing. Like a Delta variant, it has been started picking up in starting from the late of the July in the market, July in the world, like the United States and the global level. But we are seeing the very dramatic the taming down of the Delta variant is spread in the market. So probably what you're seeing in the market right now is a very natural response of the market participants that we're probably going back to the normal. Maybe not the same normal that we were living a couple of years ago, but still better than the last couple of months. So we're seeing more economic recovery activities that happening in the market, in the job market, in the consumers market. So given that, and then the changes we're seeing in the market, and also we are seeing the inflationary, the pressure in the market. When you look at the Fed, the inflation forecast is somewhere around 5% for the next 1 year. Then if you're seeing the only 1.5% yield in the market, maybe there's still some gap. Yeah, we're seeing.
Francis, one of the things that's interesting about you, and you guys have a bunch of AI ETFs, and I'm looking at, let's say, one of them, your Momentum ETF, looking at Amazon, Facebook, NVIDIA, Walmart, Home Depot, Texas Instruments. I mean, a lot of the who's who when it comes to global technology. I think that's the Craft AI Enhanced U.S. Large Cap Momentum ETF. What is your thoughts on large global technology, be it they've run up significantly if you look at some of the U.S. names, if you also then look at what's going on in China and the increased crackdown, how do you see large cap tech at this point globally?
Right. So we do our AI ETF is basically monthly balancing, actively managing AI power. So three main things. And on a monthly basis, we keep changing our models keep delivering the new portfolio for trying to cope with the market. And those the names of the global tech names currently being held into the momentum, the indexes, momentum strategy. Still, but when it compared to the market cap versus the comparable index, so we are still a little bit underrated for the tech. What we have been seeing for
so you've done rebalancing out of the mega cap tech names, is that correct?
Yes, right. Some of the mega tech we took it out, and it was like Amazon. Like we have not entered into the Amazon for the last couple of months, and we start to build a position since this month. So we are very flexible in and out of the portfolio as we managing the active portfolios. And in general, like the tech names in the world, like China, there has been a lot of concern. But when you're seeing the inflow of the ETF market, some of the China Internet ETF, we are seeing the U.S., we're seeing tremendous amount of the money inflow in there. So, I mean, there is still very concern. It's very uncertain, hard to predict. But given the ample amount of liquidity in the market, we're seeing the huge support from the investors.
Hey, Francis, just in about 30 or 45 seconds, can you explain what the AI is that you're using and the signals that you're using to make these decisions?
Sure. Our AI model is based on the quant approach. We're using the price data, fundamental data, macro data, all the same the data points that the quant analysts are looking at. But the investment process is not done by the human. What we are trying to do is we are leveraging on the machine learning technologies to make the decision by our own proprietary model. So we can just think that, okay, for the scrap technologies, they are doing the same quant approaches, but the investment decision process is done by the robot, the machine learning. And so far, we've been delivering quite decent amount of performance for the last 2.5 years since the inception.
All right, we've got to run. Listen, thank you so much. Appreciate your perspective, and especially when it comes to some of the tech names that we've been watching. Francis O, Managing Director and Head of Craft AI ETFs, joining us on the phone Tuesday morning from Seoul, South Korea. Really appreciate getting his thoughts. I mean, because he's playing in this space. Just watching the equity trade here, Tim, and we are seeing the S&P take a little bit of a leg down. It's now down about 12 points. Dow, it's definitely off its best levels of the session, paring back some of those earlier gains. Still up 72 points, up 0.2%. NASDAQ continues to be under pressure. And I got to mention this headline, Robert Kaplan to retire as the Dallas Fed president on October 8th. Wow. We just talked about Eric Rosengren of the Boston Fed stepping down. And of course, this is coming in the wake of the questioning of some of the investments that they held.
Yeah, just to repeat that, Robert Kaplan to retire as president of the Dallas Fed on October 8th.
All right, we're going to count you down to the closing bell with our Bloomberg TV team and on YouTube right here on Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Taylor Riggs, Schnally Bassick, in for Caroline Hyde, counting you down to the closing bell. Here to help take us beyond the bell, our global simulcast, Carol Masser and Tim Stenovic. And we got to start off, folks, right here with breaking news here. Robert Kaplan set to retire as Dallas Fed president. This is going to happen on October 8th. Of course, we learned a little bit earlier in the day, Carol, that, of course, Eric Rosengren over at the Boston Fed would step down as well for health reasons. Of course, both of these people, their names have been in the news for other reasons as well.
Well, following revelations about their trading activity, and this is something that Fed Chief Jay Powell was questioned about at last Wednesday's Fed meeting. So very interesting to see, perhaps not surprising. Tim and I were talking about, right, Tim, that we hold these Fed officials really high when it comes to investments, and we want complete transparency. So again, not pointing any fingers, but really fascinating and interesting to see Rosengren and Kaplan, that news coming out.
Yeah, once again, I mean, Carol nailed it with what we heard from the Fed chair last week, with several questions that were asked specifically about the trading of these officials. And Fed Chair Powell saying the trust is of utmost importance, and especially at a time like this.
And, you know, it was Diane Swonk over the economist at Grant Thornton who, during the Fed special or right before, really said the Fed doesn't need questions about their credibility at this moment, that anything related to trading in the middle of the pandemic, you know, Jay Powell said that he did not want to get ahead of the investigations, that they were investigating and looking at it closely. But he was hit with a lot of big comments. And she just really said, Romaine, that this is just not what the Fed needed at this moment. No questions about credibility.
All right, we're going to get back to this breaking news. Robert Kaplan, of course, the Dallas Fed president, set to retire on October 8th. I want to wrap up the closing bells here. As you hear and see in the background, the Dow Jones Industrial Average going to finish higher, actually, by about 0.2%. The S&P down by about 0.3%. The NASDAQ composite right now down about 0.5%. The NASDAQ 100, we should point out, down about 0.8%. That's just cyclical rotation. Nowhere else can it be found, of course, with the Russell 2000 up about 1.46% here on the day. That's about 33 points here. And we should point out that the outperformance that we're seeing on the Russell, at one point on the day, at least on an intraday basis, it was the biggest outperformance that we had seen going back to March here. I think that's been peeled back just a little bit here. I'll double check that just to get you the right superlative here. But that is the narrative here right now that we've been seeing here. Of course, that rise in bond yields feeding right now, Carol, into everything happening in the equity market.
Don't want to steal anybody's thunder, but Tim and I were talking too that it is all about the bond market and to see those treasury yields. And I think it's interesting with the backdrop of Robert Kaplan retiring as Eric Rosengren, and you do wonder about the composition of the Fed going forward and whether how that changes maybe Taylor potentially Fed think.
Yeah, we had killer comments from Mike McKee earlier. I know that we're going to get him back on the show soon to talk about that composition, Carol, that you mentioned. But in the meantime, you do steal my thunder, but I forgive you because it was a big bond day. And you really see that play out within the sectors. For the radio audience, we take a look at the sector winners, the sector losers within the S&P 500. It is energy, banks, autos, and materials. How much of all of this is because yields are rising? You're getting a yield curve steepening, and so you're up 0.7% to actually 3.5% for some of the energy companies. We migrate downward to some of the worst performers on the day, and yes, yes, it is a bond story, Carol, with utilities, some of the worst performers, real estate, you're off 1 to almost 2%, as typically, Romaine, those decline when yields are rising.
All right, we're going to get back to the gainers and decliners, but we do want to weave back into that news with Robert Kaplan, of course, the Dallas Fed president, resigning. The statement out right now by the Dallas Fed. Rob Kaplan says it was a great honor to serve. He also addresses some of the issues with regards to his trades. He said, during my tenure, I have adhered to all Federal Reserve ethical standards and policies. My securities investing activities and disclosures met bank compliance rules and standards. That is an exact quote from there in this statement. Of course, he goes on to talk about some of the other things he did during his tenure there. But again, once again here, the big news here, Robert Kaplan of the Dallas Fed stepping down today. We're learning this just hours after we learned that Eric Rosengren at the Boston Fed would also leave his position 9 months earlier than planned.
And to be fair and to maybe mirror what we heard from Fed Chief Jay Powell is you don't want to get ahead of any kind of investigation into whether or not anything was untoward, if you will. And so, again, you do have Kaplan saying those trading did meet the Fed's ethical standards. So we will continue to follow that. Yeah, go ahead.
And just real quickly, Carol, they do actually say in the statement here that, quote, Rob made the decision to retire as president and CEO of the bank effective October 8th to eliminate any distractions to the Federal Reserve System surrounding his personal investment activities. So unlike Eric Rosengren, who resigned citing health conditions, this statement does seem to be tied directly to the controversy over some of his financial holdings.
Rather quick and swift, right? And certainly you could imagine maybe potentially some of the conversations, certainly since that last Fed meeting and all of the questioning by the reporters in that room with, or at least virtually, with Fed Chief Jay Powell. All right, let's get to some of the gainers, if we may. Taylor mentioning energy. Yes, indeed, front and center. Just pick a bunch of names. Cabot Oil and Gas was among your top performers in the S&P, with West Texas topping 75. Crude prices really on a tear, highest level in nearly 3 years. But other names, Occidental Petroleum also among the gainers in today's session. Cabot Oil and Gas up 8.5%. Carnival continues its move. It is up 4 days, trading days in a row. Largest global cruise company, Royal Caribbean, Norwegian also saw moves to the upside. We know they set sail from the port of LA on Friday afternoon, first time since last year. And last week, we got the news that they're set to deploy 52 ships on the seas by the end of fiscal 2021, continuing really that move opening when it comes to the cruise industry. Just quickly, NetEase, that stock up about 3.25%. Chinese gaming company. Other Chinese companies we saw higher today. We saw China's embattled tech tycoons basically lining up to pledge their support to President Xi and his common prosperity policy and market-roiling regulatory onslaught. We saw that happening, and so we did see some bounce back, Tim, in some of those Chinese tech names.
Well, you got the gainers. I got a couple decliners at least. Let's talk Amazon. This is a big one. It's been happening. We've been talking about it all day. A price target cut at Morgan Stanley. The bank said that profits could get hit as a result of rising headcount and rising wages. Where have we heard that story before? The bank lowered its price target to $4,100 from $4,300. It does put it below the average analyst target of $4,157. Wells Fargo also finishing the day lower, but coming off those lows after we learned that Wells Fargo had reached a settlement with the U.S. Justice Department. And then Netflix eking out just ever so much of a gain of 0.04%. It did fall earlier in the day. Bank of America wasn't very impressed about Netflix's global fan event, an event that is supposed to tailor to provide detail on upcoming content. I mean, so many choices for consumers right now.
No, I'm going to make this short. We do yields as we do every day because I know we want to get back to some of the breaking news. But Carol, this really does highlight, perhaps as we were talking about yields falling 2 basis points, at least on the 10-year as of the Fed meeting last Wednesday. Since then, it has been a rate of change kind of day. Thursday, Friday, Monday, we're up 16, 18 basis points on the day. Today, further migration higher in yield, approaching 149, 150 on the 10-year.
All right, everybody, and we're going to have more coverage on the Fed, certainly in light of that news about Robert Kaplan retiring as the Dallas Fed president. That's happening on October 8th, and just coming on the heels of Eric Rosengren getting that news as well and talking about that today. All right, that's going to do it for Beyond the Bell on Bloomberg Radio, Bloomberg TV, and on YouTube. Join us again tomorrow, same time, same place. Fed coverage continuing.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, everybody, no doubt about it, our top headline right now at this hour, Robert Kaplan to retire as Dallas Fed president on October 8th, just coming on the heels, really, of Eric Rosengren saying he will be exiting his position at the Boston Fed. So let's get to our Chris Condon of Bloomberg News. He follows the Federal Reserve, joining us on the phone. Chris, whoa.
You said it, Carol. That's the second thunderclap today from the Fed's regional banks. It's quite an interesting piece of news. It would be interesting to find out whether they did this of their own volition or they really were pushed out the door. But bottom line is 2 brand new openings among the regional Fed banks. And we have a story out just recently saying that Rosengren's opening, according to the people we've spoken to, offers a chance for the Fed's leadership in Washington to take a bigger role in the search and selection process that leads up to the appointment of new presidents. So we think
explain that, Chris. Explain that. Yeah, explain that.
So as opposed to Fed governors in Washington who are nominated by the President of the United States and confirmed by the Senate, the 12 regional Fed presidents are selected by their regional boards of directors. Each of those banks has a board of directors. They exclude the members of the boards that work for banks that are supervised by the Fed. And the remaining 6 on each board are in charge of a search and selection process that goes on for many months. But that process has come under tremendous pressure in recent years to come up with candidates that increase the diversity of the Fed's leadership. And surely in the wake of this trading scandal, there'll be more pressure for the Fed to take an increasing role in supervising that process. Already, we know that Lael Brainerd is the Fed governor who's in charge of liaising with the regional Feds. And typically that governor has their finger really on that process quite closely to monitor it. And I can imagine there will be suggestions made about candidates. There'll be participation in the vetting process. So if we step back and look at this, this may be a point in time where the influence of the center of the Federal Reserve, which is already extremely strong, where the real gravity is in the Fed, will increase. And perhaps the influence of the regional Feds will decrease a little bit more.
So what does that mean for how investors should think about openings like this and the direction that the central bank goes?
And policy, yeah, exactly.
Well, it is very difficult to predict ultimately what the policy views of the person selected will be. I think it's safe to assume we'll see more female presidents, more presidents from racial and ethnic minorities to increase that diversity that's been a subject. Now, whether that results in a more liberal or looser monetary policy in the long run, that's a bit perilous to predict. So I think we'll have to wait and see what kind of candidates emerge for these positions. And then January 2023, we'll get 2 more Fed presidents as Esther George and Charles Evans reach their mandatory retirement age.
Chris Condon, if Jay Powell hadn't been questioned about this at last Wednesday's meeting, do you think this is the headlines we'd be talking about? And just got about 30 seconds left.
It certainly helped. I would say it certainly helped. And I think, too, that they anticipated that. He was clearly, he went straight to his answer book when he fielded that question. Yeah. That was not a surprise for them. This process was probably already in train, and the questions helped nudge it along, I would say.
Right. And to be fair, Tim and I have been talking about, I mean, Fed policymakers has to be complete transparency, and we have to have confidence in them. Correct, Chris? In order for all this to work. Just quickly.
It's not just about following the letter of the Code of Ethics. It's about being above any questions about conflicts of interest. And in these cases, unfortunately, these guys really failed to cross that bar.
All right, great. Thank you so much. Quick analysis, so great. Chris Condon, he covers the Federal Reserve for us here at Bloomberg, joining us on the phone in D.C. So pretty amazing in terms of the headlines that we've seen.
Yeah, what Chris was saying, I mean, you think a lot about the appearance, the term like the appearance of the conflict of interest versus actually a conflict of interest. And I think this really, what he said is that there can't even be an appearance of a conflict of interest because trust is so important in the institution. And that's why it's perhaps, shows that the trains, as he said, were already in motion.
Right. When it comes to monetary policy, and we've all had discussions, you've heard people voice their opinion about politics getting involved, but you and I have talked about when President Trump was putting pressure on Jay Powell, and you need to know and have a reassurance that the Federal Reserve is acting on its mandate, understanding its mission, and that's what guides them, and that's it.
Well, speaking of Jay Powell, we do have a statement from Jay Powell, chair of the Federal Reserve System Board of Governors, on this resignation of Robert Kaplan. He says, quote, "We are grateful for Rob's 6 years of service as president of the Federal Reserve Bank of Dallas and as a valued colleague in the FOMC. He has been a passionate and forceful public voice on a wide range of issues, including the critical value of early childhood education and literacy. In addition, he strengthened the bank's economic research and played a very constructive role in system-wide management, budget, and technology efforts. We wish him well."
All right. Well, a lot of news on this Monday. And as we heard from Chris Condon, changes certainly when it comes to the Fed and maybe more concentration of power centrally versus those regional banks. All right. Let's get another check on world and national news. Not world and national news. Let's get a check on your top business news and another look at that trading day. Let's turn things over to Doug Krisner. Hey, Doug.
Hey, Carol. So in the terms of a lot of the change that you've been talking about with these Fed Bank presidents stepping down, Rosengren, the head of the Boston Fed Bank president, is a notable hawk, and analysts were pointing out earlier in the day he is likely to be one of the higher dots in the Fed's dot plot. And Rob Kaplan over at Dallas, he's been for a while now talking about scaling back asset purchases. So both members, relatively hawkish. Their replacements, well, that's a wild card at this point, but it's going to be interesting to see how the composition of the FOMC changes as a result. Dow Industrial Average today better by 0.2%, but we also had a move up in long-term interest rates. That seemed to put a dent in tech stocks today. A lot of focus on equity valuations, and as a result, the NASDAQ composite weaker by about 0.5%. In the broader market, real estate and healthcare leading the S&P 500 down about 0.3%. Big day in the crude oil market. WTI finished up 2% in New York and moved above $75 a barrel. Seems clear the market is tightening given this global energy crunch that we've been talking about. Goldman Sachs saying that Brent could hit $90 by the end of the year, and Goldman saying the market really is in bigger deficit than many realize. Right now, in the extended session, WTI 75.45, Brent at 79.40, 10-year Treasury 1.48%. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug, thank you so much. Doug Krisner there. So global supply chains are strained. We know that. Companies trying to restock pandemic-depleted inventories, and just everybody wants lots of stuff. And as they do, tens of thousands of containers are stuck at the ports of Los Angeles and Long Beach, California, two crucial gateways. For those watching on YouTube, you're going to see our Ed Ludlow, and behind him are all of those container ships just waiting to go somewhere.
Ed Ludlow joins us now. He's West Coast correspondent for Bloomberg News. He joins us live from the Port of Los Angeles. Again, check this out on YouTube. Because
he was out there when it was dark this morning.
I know, 3:30 a.m. So, Ed, thanks for doing this. Hey, give us the numbers, though. I mean, just how many ships are anchored off the port? How many containers are out there right now?
Yeah, it's as worse as it's ever been. There's around 64 container ships anchored in the Bay of San Pedro. You can't see it behind me, but you take my word for it. And the kind of key stat is they're actually staying there for longer, around 9.5 days, just waiting for a berth. And the problems are pretty simple, if anything in life is ever simple. It's that they can't get the containers off the ships quick enough, put them back on and bring the next ship in. That is partly because of what's going on in the port here, right? There is a shortage of semi-truck drivers. You may be able to see the semi-trucks behind me, some of them with the single 40-foot container loaded on, some of them are empty. But the point is that they can't shift them quick enough. And you combine that with the bottlenecks further down the supply chain. The train terminal here in LA is backlogged. You go into Central California in the Central Valley, Fresno, there are just miles and miles of trains with containers not going anywhere. So this extends well beyond just the issue of sea containers.
Right, and we're hearing it from companies talking about supplies and things and goods just being, left there and not getting to where they need to go. So, Ed, how how much longer does this continue?
I mean, that is the billion dollar question, right? The forecasts vary. You know, it's not going to end in the next few weeks. The main concern right now is the holiday season, which is a contributor to the problem. There is this big surge in demand, partly because you have retailers, e-commerce giants like Walmart, like Amazon, like IKEA, basically trying to get ahead of the holiday season. They are restocking actively, trying to get inventories to a level where you remove the risk that the shelves are empty around Christmas time. That is the fear. But the reality is that it will go much longer than that. You know, one forecast we heard from DHL Supply Chain on the show earlier today was probably February of March of next year. Gene Soroka, who's the executive director of the port, said maybe as far into the beginning of 2023. There are longer-term structural issues as well that need addressing.
So, Ed, what should things look like there? I mean, in a typical time, how many ships should be there? How long should they be spending time there? What will a return to normal look like?
Well, part of the problem that Gene Soroka, the executive director of the port, outlined to us is that demand has risen, right? So the traffic that's coming through the port has risen by, say, 30% compared to pre-COVID norms. But the rest of the facilities needed to meet that have not risen to the same extent. Truck availability has only risen by 8%. So there is a deficit there. The port is undergoing major investment, and also technology is the problem. There is very little automation that goes on here. Simply put, you have a pile of containers. You can see them behind me. The crane comes and picks one up and puts it down on a single semi-truck, which sounds like an automated process, but really it's not. It's incredibly manual. So they want to see investment in technology that will make the process better. As people keep pointing out to us at Bloomberg, a big problem is rail. The dwelling time, in other words, the time that the trains are spending at terminals before moving, is even greater than what it is here at the ports. So they want to see that infrastructure in rail so that further downstream we can see some improvements and more smoothing out of the supply chain.
You know, Ed, sometimes what happens is when there's a crunch, and we certainly saw this during the pandemic as people figured things out, that you just ramped up either production or you went 24/7.
Build the boats.
Build it,
ships.
go.
Yeah.
But I mean, if you don't have the people to drive the trucks and stuff, I mean, do they just not even have the people and what's necessary to go 24/7?
Yeah, I go back to the demand side of the equation. Remember that at the worst points of the pandemic, there were pockets of demand that just disappeared. And for that reason, for example, in the trucking space, drivers had nothing to do, so they went elsewhere. They got jobs in other industries. Now they are being, it's hard to get them to come back, and simply put, because they command much higher wages. We're going to have a really fascinating interview coming up on Bloomberg Television with UCLA Senior Associate Dean Chris Tang, who looks at a much more global perspective of this. This pandemic has exposed how reliant the United States is on manufacturing, not just of things like semiconductors from Asia, but all kinds of goods. And it's investment in those areas that they want to see, some onshoring of the supply chain.
Well, that's what I'm curious about. And I have had conversations, I'm sure you have, I know Tim probably has too as well, in terms of the CEOs that have come on. And some say, well, we're already doing onshoring. It makes sense from a climate impact, carbon impact, and just it makes sense to be doing more production in the places that we sell. I don't know. I still feel like it's a global supply chain, and that's not that really happening that much.
What Poonam Goyal told us
Yeah.
last week about Nike, you can't just, if 40% of shoes are coming from Vietnam,
Right.
that's difficult factory production to move to another country, let alone the United States.
So is more onshoring happening, Ed?
They want it to happen. You had Gene Soroka telling us that we need investment for the federal government. This is how his words, don't take it from me.
Asia factory output is at record highs, yet we're still behind on orders. Increases as much as 30% in vessel capacity in the Trans-Pacific have been deployed, yet we still don't have enough space. Cargo coming here to the port is like taking 10 lanes of freeway traffic and compressing them into 5.
I mean, that sounds to me like a call for help, right? That sounds to me like him saying to the federal government, get your checkbook out, we need more infrastructure.
Infrastructure. You know, I remember a few years ago doing a story about the Port of Miami, and they were making it deeper and making it so bigger container ships could come in because so much stuff was coming from overseas and being able to accommodate it. But it does feel like even the existing ports, and you see it certainly on the West Coast, Ed, they really are being maxed out at this point. Pandemic or no pandemic, we're kind of hitting a level where something has to be done to improve capacity.
Yeah, and these aren't quick fixes. You don't just build extra capacity overnight. It takes years and billions of dollars. The one thing I point out very quickly is this is just where the containers get dropped off. Remember what's happening at the point of origin, China. 7 out of 10 of the world's biggest ports are in China, where policymakers won't hesitate for a second to shut down an entire port if they want to stop the spread of the Delta variant. And that is what's happening out in Asia.
Hey, Ed, you mentioned automation and the fact that there isn't much automation when it comes to the process of unloading these and getting them onto trucks and getting those trucks and getting those goods across the United States, across North America. What does the future look like for that? I mean, is this something that is actively being developed, that's actively being worked on, and what's a timeline for that?
Well, the irony is that here at the Port of LA, they are undergoing a multi-billion-dollar refurbishment and update project. But the problem is that because of that, some of the capacity is taken out while it's under construction. It is adding more machinery. It is adding new technologies, greater scale of these kind of mega cranes that you see in the likes of the Chinese ports to kind of ramp up that volume. But patience is a virtue, you know, and we've kind of been grilling all of these different industry participants today who are saying, hold on, guys, that there are some systemic, some structural issues that don't just go away, even if the supply chain improves.
Ed, what strikes you the most in reporting out this story and talking to people who are directly on the front line there?
It's how interlinked everything is. We take for granted goods moving from A to B. It's incredibly complicated. I'll give you a very quick example. Prior to the pandemic, 40 or 50% of air cargo flew in the belly of passenger flights. Well, of course, there aren't any international passenger flights. That is a really depressed industry. And so you say to them, well, hold on, if you're struggling with the boats, why don't you just stick it on a plane? Well, that's the answer. The industry is desperately waiting for international passenger travel to open up so they can start putting cargo into the belly of those planes. And that is something that I hadn't considered going into it. I thought it was all about those big container ships behind me.
It's a good point, right.
Yeah, that is a really good point. You think about, I mean, a supply chain like Apple, for example, with its new iPhone and the way that the company relies on air freight. Hey, Ed, how should consumers think about this and think about this ahead of the holiday season? I mean, we look, it's fair
buy
to say
now?
that.
Too late already?
Look, I mean, the executives of retail companies have told us to buy now because they want to sell, but how should we be thinking about it?
The worst case scenario that's been painted to us is that you go into the store and things are missing from shelves. What we're seeing, and remember, we're 2 weeks out from what will be a fascinating earnings season. We have really dramatically higher input costs. Do those costs get passed on to the consumer? There are so many examples where we're already seeing it playing out. Real inflation on things that you take for granted every day. Although I would note that there is some sanguine element in the market that says, hold on, yes, there are higher input costs, but pricing pressures were already there anyway. Things are commanding a higher price, so relax, everyone. I don't know. We'll see what comes out in earnings season.
Just relax.
We will. Listen, this is, though, one of the big stories right now of the moment. Ed Ludlow, West Coast correspondent, Bloomberg News, there in the Port of Los Angeles. Just want to remind you what is our top read story here on the Bloomberg, and really a key story. Federal Reserve Bank of Dallas President Robert Kaplan will retire on October 8th in the wake of embarrassing disclosures earlier this month about unusual trading activity. He put out a statement that was emailed. Unfortunately, the recent focus on my financial disclosure risks becoming a distraction. For that reason, I have decided to retire.
Yeah, Fed Chair Jay Powell weighing in on this as well, saying, quote, we are grateful for Rob's 6 years of service as president of the Federal Reserve Bank of Dallas and as a valued colleague in the FOMC. He strengthened the bank's economic research and played a very constructive role in system-wide management, budget, and technology efforts. We wish him well. Remember his announcement coming just hours after the Boston Fed said that Eric Rosengren will retire on Thursday.
Yeah, some big changes there to come, certainly at the Federal Reserve and those regional banks. All right, you're listening to Bloomberg Business Week. Alan Patricoff up next.
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, so I sometimes say this a lot, to grab a nice drink, pull over, relax, because we've got a great deep dive that
Hopefully
we're
if
going to
you're
do.
going to grab a drink, you're not,
Well,
drugged, but
no. They're separate things. They're separate things. Coming up is Alan Patrikoff. He's a venture capitalist. He is a big-time fundraiser for the Democratic Party. He is, of course, of Graycroft Ventures, co-founded that firm, also co-founded Primetime Partners, investing in companies that can transform the quality of living for older adults. There's so much to talk to him about.
Yeah, I want to talk to him all about taxes, politics,
Yes.
and, of course, where he'd be putting his money these days.
Exactly. So we'll get to him in just a moment. First up, though, back to Doug Krisner with a check on your top business stories. Hey, Doug.
Hey, Carol. So obviously big news today with two Fed presidents stepping down. A short while ago, we learned Dallas Fed Bank President Rob Kaplan will retire effective October 8th. Earlier in the day, Boston Fed Bank President Eric Rosengren said he will step down this week due to a long-standing kidney condition. Now, to be fair, both of these departures follow some embarrassing disclosures about unusual trading activity last year by both Rosengren and Kaplan. In terms of the equity market today, we ended mixed. On the positive side, we had strength among economically sensitive stock groups like energy, financials, and materials. But tech stocks moved lower given a spike in long-term interest rates. That move up in rates put a very bright light on equity valuations. We had the NASDAQ comp dropping a little more than 0.5%. In the broader market, weakness in real estate and healthcare led the S&P 500 lower by about 0.3%. The Dow popped 0.2%. But look at the small caps. The Russell 2000 today up about 1.5%. Endeavor Group is buying OpenBet from Scientific Games. Price tag here is $1.2 billion. Shares in Scientific Games have been halted right now, but Endeavor is trading in the late session. It's higher by about 1.6%. 10-year Treasury last quoted in New York at a yield of 1.48%. And look at crude oil, higher by 2% in New York today. We're above 75 a barrel at 75.45. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug, thank you so much. Do also want to mention Federal Reserve Chairman Jay Powell saying supply bottlenecks have been longer lasting than anticipated, and he expects inflation pressures to remain high in coming months before easing. We are getting a release of his expected testimony to the Senate Banking Committee, which is coming up. He says these effects have been larger and longer lasting than anticipated, but they will abate. And as they do, inflation is expected to drop back toward the longer run 2% goal.
The Fed.
The Fed.
The news continues with the Federal Reserve.
All right, so let's get to it because we have a really great voice to talk about so many different big issues that are facing our time right now. And that includes higher taxes that certainly President Biden is looking when it comes to his planned spending plan that covers, as we know, soft and hard infrastructure. Great to have back with us Alan Patrikoff. He's an early venture capitalist, helped build and grow many companies, including America Online, Apple Computer, Audible. He's a chairman, emeritus, and co-founder of Graycroft Ventures, also chair and co-founder of Primetime Partners. He joins us on the phone from East Hampton, Long Island. Alan, great to have you back here on Bloomberg Radio. How are you?
I'm doing great. A day with 79 degrees in late September, you can't argue.
It is really kind of beautiful fall days. A lot of Fed news. We're going to get into, I know we want to talk taxes with you and what it means for the VC market. But we did just hear from Jay Powell talking about still, constraints in the system. We also had news, Federal Reserve Bank of Dallas President Robert Kaplan's going to retire October 8th in the wake of embarrassing disclosure earlier this month about unusual trading activity. Just coming on the heels of Boston Fed President Eric Rosengren saying he will retire. We got that news on Thursday. How do you see all of this?
Truthfully, I think it's disturbing. I mean, to think that there's conflict of interest, that there's the possibility even of trading by people in that kind of senior position is, frankly, I don't want to overdo it and say shocking, and I have no knowledge of whether it's true or not true, but just to even think there's a possibility of that happening is discouraging, and obviously we've seen it in Congress. We've heard about it all throughout the system, and there needs to be, I guess, a lot more checks and balances to make sure this doesn't happen, and that it's not even something that's being considered. In terms of supply shortages, I echo what the Fed chairman has said. I mean, I'm seeing it every place, and people, when they tend to hear this chip shortage, they think of computers, but it really permeates everything. It's medical devices, it's simple the things you use in your everyday. It's your toaster ovens. I mean, chips are every place, and that's one major holdback, and it's affecting a lot of industry. And there's shortages all over, and there are delays. I mean, I'm sure you experienced yourself. It's something you wanted. They said, "I'm sorry, it's going to be 1 month or 2 months because we don't have the parts."
We've all been there, and get ready for the holiday season.
Well, we just had our
there.
Ed Ludlow out on the LA ports, and just you see all the container ships just piling up.
Hey, Alan, I want to go back to something that you said, because you mentioned members of Congress, and I think a lot of people listening right now would say, "Wait a second, we don't really see many guardrails on what members of Congress are or are not allowed to do when it comes to trading activity, and it's come under scrutiny many times in recent years." Do you think there needs to be more regulation about what members of Congress can and can't do when it comes to buying and selling stocks?
Listen, I think it's a sine qua non. If you've got people who are passing legislation or approving laws, or whether it's judges or people in political positions, we want to feel that they are independent and their views are independent, and there couldn't possibly be a bias. Now, I am not accusing or even thinking that people are, wantonly violating rules and taking advantage of it, but there should be something in place in general that just eliminates that possibility.
I thought it was interesting what you said about, we know this, chip shortages, chips are everywhere, what Jay Powell had to say about supply shortages. Alan, I do wonder about, companies, CEOs, leaders that you talk to, portfolio companies that you guys are invested in. Are you hearing from everyone that it's just really difficult out there when it comes to the supply chain?
It's pervasive. That's why I say I don't think it makes any difference what industry, whether you're in the cybersecurity area or whether you're in a new medical device, or it just, I'm sure boat manufacturers have the problem of supply sources for their radar systems. I mean, it's or for infrared systems. I mean, it's just there is definitely a backlog created by the pandemic, created by lack of personnel in a lot of companies who are down, not on full-time shifts, and certainly, I mean, it must be very hard to go to 3 shifts a day today for any company. So it's hard to eat through the backlogs they have. On the other hand, it's good. I mean, it means that there's a lot of demand around.
Right. Well, how do you see the economy? You can only imagine, and I'm sure you have it with colleagues and friends and peers, how many conversations that we obviously have about just trying to figure out where we are in this economy, certainly coming on the heels of last week's Fed meeting, where Jay Powell not worried really about inflation. A lot of metrics have gotten better, but there's still a lot to improve. How do you see where we are in this economy and where we're going? And is the Fed policy appropriate in your view?
Yeah, I think it is appropriate. I think that there's got to be a gradual tightening, and the inflation is much more of concern than it was probably 3 or 4 or 5 months ago. I think there is an offset, and that I do believe that the ending of the unemployment benefits and special benefits that were given as a result of COVID, which were very much needed, have now put a lot of people in a position where they're not going to have choice but have to go back to work. So I think we're going to gradually see the employment picture continue to improve as people.
But we do still continue, Alan, to hear from executives at companies around the country that have such a hard time getting talent right now, whether that's in warehouses or in the C-suite. And I wonder what your portfolio companies are telling you about trying to get talent right now. We had Fran Katsoudas from Cisco Systems on last week, and she said, they're raising their salaries, what, Carol, was that 5%?
Pretty significant, yeah.
Yeah, pretty significant.
Or more, I thought she said, yeah.
In order to get people to come work for them. What are you hearing from your portfolio companies?
Same, ditto. I mean, it's everybody's having problems. On the other hand, it is pushing wages up, which is an inflation factor. So I think that we're going to see more of that. And, the minimum wage may end up being an academic discussion in terms of what people really are having to pay to attract people to join the workforce. But I see that gradually evening itself out. Certainly as soon as people are fully vaccinated, all these things are going to work towards a better situation, certainly as we go into the Christmas season and coming into the spring. So I think this thing will work itself out, but at the moment I can see a lot of inflation pressures appearing.
All right, there's a lot going on, I don't have to tell you, in this world, and this is going to be a big week potentially for President Biden as he continues to try and get his agenda through when it comes to hard and soft infrastructure. And as you know, looking to raise taxes to pay for that spending plan. You have some concerns about some of the policy being talked about. I know we talked a little bit on air, Alan, about a tax break that basically lets, as our reporting goes, tech industries, millionaires and billionaires kind of shield their winnings from the IRS. And we talked about the obscure provision of the tax called Qualified Small Business Stock, or QSBS, which benefits a lot of venture capital-backed startups in tech and other industries. Is that what you're concerned about?
Well, let's put it in a right perspective. I have been supportive all along of making carried interest into ordinary income, and that is front and center, the major point of almost anyone in the venture or the private equity or the real estate business. It's been an abuse of the system. Carried interest is ordinary income. I'm saying that in my opinion, but it's a fact. I mean, it's part of how you get your earnings, and I benefited from it, and I'm willing to be outspoken in saying I think it's something that should be addressed. I mean, the last change it took from 1 year capital gains period to 3 years. Now the proposal is to go to 5 years to be eligible for carried interest capital gains treatment. But basically, carried interest is ordinary income, and I'm happy to debate that with anyone. Now, what the QSBS situation is a particular feature that's been around since 1993. It came in with the Clinton tax code change at that time, and it didn't have very much impact in stimulating business because it was offset by the AMT, and it was only a 50% benefit. And so really, not many people used it. It was only in 2008 when President Obama, to stimulate activity in the small business area, changed it to 75%, then 100%, and then eliminated the offset of the AMT, that it really had benefit. And since that time, it's been used very, very broadly by not just, I hate to hear the pejorative of millionaires and billionaires. It's a little bit overstatement. It's used by anyone it should be used, frankly, by anyone who's starting up a young company, which has enormous risks associated, including the entrepreneurs, who are the biggest beneficiary. If you start your own company, you benefit from QSBS, just like the investors get benefit from. And a lot of people have relied on that certainly since 2008, and in many cases before that, where they didn't have the concern about the offset of the AMT. So there are a lot of people with lots of investments in their portfolio that are expected when they realize, some of them, if you think about it, they've been there since 2008, they've been there 13 years, and they haven't realized on the profits of the investment, but they've realized the losses in many cases. I mean, there's a very high loss ratio in starting up and building young companies, and it's only for companies up to raising a total of $50 million, which may seem like a large money amount, but it really isn't, because the biotech industries includes a lot of capital-intensive industries, and it's to take care of that early stage. And now the proposal is wrapped in here and slipped in. I don't mean deviously slipped in, but it's slipped into the system, which is to cut it to 50% for anyone with incomes of over $400,000, which is going to affect a lot of entrepreneurs as much, if not more so, than the investors. And I'm open-minded to the fact that, okay, going forward, perhaps they want to, the president needs tax income from various sources, and of course, when you need it, you reach out any place you can. But I think the first thing is to deal with people who have invested on a basis of expecting this to be qualified under the QSBS 1202 of the tax code. And now, then there's the second part, which is going forward. Now, going forward, I think there's certainly room for coming in with some constructive approach to that benefit. But mixing the two is really, to me, unfair and appropriate.
Do you agree with the president and many Democratic politicians who say that the wealthiest Americans are not paying their fair share?
Absolutely. I totally support the president. I support the infrastructure bill. Both bills that are being discussed, negotiated, compromised, hopefully, and I would certainly do anything I could to help get it passed. And I think it's essential for the Democrats that it gets passed. And I think that we have unfortunately a bifurcated economy, a bifurcated system in this country where we do have a lot of people who have benefited, I wouldn't say unfairly, but have benefited to such extremes. And while at the same time, we have a lot of people who are just not participating. And this has to be addressed. If we don't address it,
what is the best way to address it? You mentioned closing the carried interest loophole that many would argue there's a loophole. But what are the other best ways to address it?
Well, I think there is a way of addressing income and how income is taxed, and particularly CEO disparities compared to other people working on the company. And I don't know. I'm not a socialist. I'm a capitalist first and foremost, and I've been that for all my life. But I do think that gets to a point where enough is too much, and I think that we have. The billionaires of this country, perhaps we have to find a way where there's some kind of mechanism, and I don't have the answers. I'm not Congress, and I'm not legislating, and I'm not making tax policy, but there's got to be a way to find a way where we have some more equality in the sense, not that everyone is going to be treated the same, but that there has to be, there's just too much differential between the tops and the bottoms.
I know some of our...
I think the president's tax bill does go towards ameliorating that to some extent with the earned income tax credits and helping poorer people in terms of subsidies for their care, for home care, child care. All those things contribute to helping solve some very serious burdens that people are bearing.
Hey, Alan, some of our reporting that we've done has said that some people who have been holders of QSBS have, been rushing to sell their shares, hoping that they can, claim a full tax break on next year's 1040 form, just in anticipation. Have you seen signs of this? I mean, I think part of tax code is so complicated, and I think there are lots of moving parts to it.
Let me interrupt and tell you. The answer is no, I haven't seen it.
Okay.
A. B, if I read it correctly, it wouldn't do much good because it's effective the 13th. So that doing it today is kind of the barn doors closed. I mean, for example, we have two companies that are in the process of being sold, both of which are QSBS. That we're in both these particular companies, one for 7 years and one for 13 years, since 2008, maybe 2009, and we haven't completed the sale. And based on what is pending and what's possible, they will not be eligible for QSBS. So, and we couldn't accelerate the sale anyhow. I mean, companies don't get sold. These are not on the stock market. These are things that are private companies, and these are private transactions. I can't even disclose to you, much less realize on it to capitalize on QSBS. When it comes, it'll depend on what the tax system is at the time it's sold. But the shame is that it was invested at a time with the incentive of QSBS taxation.
Well, so what is your expectation, Alan, if this changes, if indeed President Biden, the Democrats, or some of them get this through, how do you think it would impact the venture capital scene? Because I think there's often arguments saying, people aren't going to invest in innovation. and so on. And yet it does continue. I find it hard to believe that you might think twice, maybe, but I find it hard to believe that venture capitalists would pull back completely.
I think, in honesty,
but help me.
I think you're not wrong. You're not wrong. The market's not going to shut down. I do think this is just an added incentive for people to take risk. I mean, it's a lot easier to be in the private equity business, a lot easier to be in the stock market. If you don't like the stock market and you don't like your company, the next day you sell it. I mean, or the next hour or the next minute, buy it and sell it if you don't like it. When you're in a private transaction, you're in it for life. I mean, you're in until something happens, a liquidity event. So you become a partner in that business. You may not be called a partner, but you, in effect, are a long-term partner. I just gave you an example of a company we've been in 13 years, 12 years. I'm not sure the exact date. And we haven't had the ability to sell it for 12 years. And we took a high risk at almost all these companies were, remember, at ground zero when they started.
Right.
And the fact that they succeeded doesn't talk about all the losses we've incurred in various other companies that were QSBS qualified that died on the way. It's just like being in the drug business. You have a lot of drug development of things that die,
right?
And you have the few that make it. I mean, we're in a high risk, long-term development business.
Alan, you mentioned private equity, and there's tons of money, and they have dry powder, and we talk about private equity a lot. Do you think it's unfair, kind of, the freedoms that private equity seem to have compared to your market, the VC market, the public investing market?
I'm not sure what you mean by.
Well, it seems they certainly have a lot of ease in terms of, as you said, getting in and out of investments. And if they make an investment and want to sell the next day, they really can easily.
Not for private equity. That's more for public market ownership. If you're in a private equity deal, you also are, have illiquidity. And it's just you're dealing, what I was referring to is you're dealing with much larger sums for the most part. And so they really don't come in under the QSBS. I think it's probably not an item at all for a private equity investor.
Oh, I see what you're saying. Okay.
Unless they're in a much earlier growth stage. But even that, it would dissipate very quickly. It's more applicable to the early stage companies,
like angel investing and so on.
Yes, exactly. This affects all angel investors. I'm glad you brought that up. This affects every angel investor because you're going at ground zero and and you're taking a risk and you're in for a long haul, and this is an added incentive. Will it have a long-term effect? I can't say, but I certainly is not going to. At a time when we want to encourage entrepreneurial activity, when we're talking about not enough startups, this certainly is not. This is like a kick in the butt rather than go get them and encouragement. So I think it sends a different kind of message, and I think knowing the president, I think he would probably, if he had looked at the specific aspect, would think this is not the kind of thing where I should be.
Have you guys gotten an audience with him at all about this?
No, I haven't, certainly. Okay. But I think hopefully other people are, or if I got called upon, I certainly, as you can tell, I have a point of view. But
which is why we like talking with you.
In general, I'm very supportive of the program. I hope, like heck, that we get this debt ceiling, waived, and I hope we get the two bills in. I think it will be a game changer for everybody, for you, for me, for every state, every political persuasion, and it defies my imagination that there could be some people who, for political reasons, just don't want to support something that's going to be good for their constituencies. It just doesn't make sense.
Hey, Alan, we only have about 45 seconds left, but I do want to get an update on Primetime Partners, an early-stage VC firm that invests in and builds from the ground up companies that can transform the quality of living for older adults. This is something that you launched in July of 2020. Give us an update a little over a year into it.
I'm so happy that you asked that. I saw an interesting white space of an area where everyone's focused on millennials, and I said, what about the older population, as I like to call them, the ageless population, which is the fastest growing part, believe it or not. There will be more people over 65 than there will be under 18 by 2030. And they need everything. I mean, and they need different things. Their homes have to be different. They need remote monitoring. They need caregiving. They need support services. They need supplies, products, services, technologies. And we made 18 startup QSBS qualified. Maybe not all. Maybe they didn't all qualify.
Alan, you've got to come back. I fought for a lot of time with you, but we always wish we could have more. Alan Patricof, of course, chairman of Greycroft and co-founder of Primetime Partners, joining us right here. You can check that out on our podcast feed. This is Bloomberg.
From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Instagram taking a pause on its kids site after continuing concerns about the platform's impact on teens and children. But parent company Facebook isn't abandoning the idea completely. We'll discuss. Plus, what about YouTube? YouTube CEO Susan Wojcicki tells me she believes Google's popular video platform is beneficial to teens' mental health. Part of my exclusive and wide-ranging sit-down with her this hour, from the impact of social media on kids to content issues in Russia to the possibility of reinstating former President Trump. And text messages tell all. We're getting an inside look at the relationship between Elizabeth Holmes and her ex-business partner and ex-boyfriend, Sunny Balwani. We'll bring you an update on the trial of the Theranos founder as she faces 20 years in prison. We will get to all of that in a moment, but first let's get a look at the markets with our own Kriti Gupta. Kriti, take it away.
Emily, a down day in the markets, and an even worse day for technology stocks. And you just see behind me, the sea of red that you're seeing. The S&P 500 down 0.3%. Really important part of this is those big tech sell-offs, because you saw the NASDAQ 100, which does carry a lot of the tech stocks in it, really drop in sympathy. But then when you sell those big tech stocks come back up, your Apples, your Amazons, your Microsofts, pairing some of those losses, the NASDAQ 100 not really getting in on that trade. What did do well, though, of course, was a lot of those cyclical trades. This is pretty interesting because it came in tandem with that rise in 10-year yields in particular. You saw treasuries lower. I want to flip up the boards and connect the dots, though, because you have to talk about tech and yields together. Because, Emily, at one point, going all the way back to February, you can see that red below me, you had an inverse correlation between yields and tech. Essentially, when yields spiked higher, tech really sold off and really hit that broader index. Today, though, a much more positive correlation. So why are you seeing yields higher, tech lower? Emily, it has everything to do with rebalancing, month-end rebalancing, quarter-end rebalancing, taking some of that money out of tech completely and reallocating to what didn't do so well, those cyclical stocks, and of course pulling some money out of treasuries as well, which brings me to some of those subsectors that we really have to look at when it comes to that tech trade. I mentioned tech broadly is underperforming today, so you did see the semiconductors NASDAQ biotech index in on that trade. What did better, though, what outperformed, Emily, was Chinese ADRs, U.S.-listed Chinese stocks that have been under pressure for so long. Today, they really stole the cake, Emily.
All right, Kriti, thanks so much for that. Now, with Facebook under fire for potentially being toxic to teens' mental health, the CEO of YouTube, Susan Wojcicki, says she believes Google's video platform can be beneficial to adolescent mental health. I spoke with her in an exclusive and wide-ranging conversation for an upcoming episode of Bloomberg Studio 1.0. Here's what she had to say about this in her first public comments about the recent Wall Street Journal investigation into Facebook.
We do have a panel of experts that we work with to be able to help us understand what are the different ways that our product could be used, or what are, how do we face some of these challenging issues to make sure that we're getting the best advice. We certainly do see, for a lot of really tough issues, that YouTube can be a really valuable resource. So body positivity, mental health, we see a lot of creators actually talk about mental health, and that for a lot of kids, it's really, it like destigmatizes and enables people to talk about what's happening and what's going on with them. So we do take it very seriously, and we certainly look also at any kind of third-party research that we would see on the topic.
The potential long-term impacts of YouTube on teens and on children, whether it is toxic or whether it's addictive, is that something that you wonder about? Is that something that you struggle with, not just as a CEO, but as a mom?
We certainly want to make sure that we are doing what we can to be responsible with kids and in every way possible. And that's one of the reasons that we actually have worked hard to give parents as many options as possible for them to decide what is important for them and their family, whether that's like limiting screen time, like limiting what is the content they actually have access to. I mean, even letting parents just say, these are like the 10 videos. My kid can only see these 10 videos. And so that is really important for us to give the tools back to parents for them to decide what is best for them and their family.
How much do you internalize the criticism of YouTube's content? Do you take it personally? And how does that influence the decisions that you make as CEO?
I want to be doing the right thing, and I care about that. I care about the legacy that we leave. I care about the world that we leave to our children. I care about how media is consumed by the next generation and by everyone today. And so I really have put a lot of time and effort to make sure that we are acting responsibly. And there's always a balance between the free speech and the right, but being responsible and taking down content that we think could lead to some kind of real-world harm. And so, I mean, sure, I think whenever you're in a position like that, there's going to be a lot of criticism. But our goal is just to continue to talk to experts and evolve.
More of my exclusive interview with YouTube CEO Susan Wojcicki coming up later this hour. Meantime, as we mentioned, Facebook is pausing its work on Instagram Kids, the initiative aimed at users under the age of 13. The social network has come under intense scrutiny for the potential negative impact of Instagram on teen girls. Facebook says the pause will give the company more time to work with parents, experts, policymakers, and regulators. Head of Instagram, Adam Mosseri, wrote in a blog post, "I have 3 children and their safety is the most important thing in my life. I hear concerns with this project and we're announcing these steps today so we can get it right." Earlier this month, several members of Congress wrote to Facebook urging it to drop Instagram Kids entirely. Bloomberg's Naomi Nix joins us now for more. So Naomi, what do you make of Instagram making this decision now?
I think they're realizing that the backlash is too big right now for Facebook to unveil a project like this. I think they're recognizing the political scrutiny and they're trying to work to address it. I do think, however, they're not actually backing down from the central premise of the app, which is, the reason they said that they wanted to do it is because young people are getting on Instagram anyways. And, Facebook might as well give them a safer product. And so they're just recognizing that they're going to have to sell this product a little bit more before they can actually launch it.
I asked Adam Mosseri about this a couple of months ago and said, why shouldn't Instagram for Kids terrify me as a parent? And he kind of doubled down there. Take a listen to what he had to say.
We knew we were going to get a lot of scrutiny over this and a lot of criticism, but fundamentally, it's just the right thing to do in our opinion. And so we're pushing forward and trying to figure out how to build a version of Instagram for kids that is safe, that deeply empowers parents so that they can have oversight and control over their children's experiences and keep them safe.
Now, in his blog post today, where he said, actually, we're going to be backing away from this for a moment just to make sure that we do get it right, he mentions YouTube for Kids. What's the difference between an Instagram for Kids and a YouTube for Kids?
That's a really good question. I think part of what's come out in the reporting from the Wall Street Journal is that there's definitely a significant number of kids who feel like scrolling through the camera-ready photos and Instagram makes them feel worse about themselves, particularly teen girls struggling to be confident about their appearance and their bodies. And YouTube, there is definitely problematic content on YouTube and misinformation, but it's not a platform that's sort of as geared towards celebrities posting their seemingly perfect lives and promoting that kind of digital popularity contest in the same way that Instagram is. And I think that's one of the biggest issues.
Well, it's certainly interesting given Mosseri invoked his own children in his response today, which is, something that Susan Wojcicki also talked about, thinking about how these platforms impact their children. Meantime, Facebook has pushed back more broadly again on this reporting from the Wall Street Journal and the fundamental contention that Instagram knew it was quote unquote toxic for teens and did nothing about it. This coming from Facebook's head of research saying it is simply not accurate that this research demonstrates Instagram is toxic for teen girls. The majority of teen girls who experience body image issues still report Instagram either made it better or had no impact. What's your takeaway from this statement? It's not necessarily the strongest argument, either better or no impact.
Yeah, I think I think it might be Facebook's best argument, right? They're saying, look, there are some factors where, we're not hurting kids. And yeah, for a certain group of people, we may be hurting them, particularly when it comes to their, their self-confidence. But I think we should expect to see Facebook to continue to push back. So there's a congressional hearing on Thursday where one of Facebook's top executives who's been working on this issue will be testifying. We should expect her to be defending Instagram and Facebook as a place that's safe for young people. We're also expecting Facebook to be releasing more research on the topic.
All right, well, we'll be looking forward to that. Bloomberg's Naomi Nix, thank you for your insights there. Coming up, log jams in LA. We're going to take you live to the port of Los Angeles to show you the global supply chain crunch in action. Our special coverage coming up next. This is Bloomberg. Happy news, Bloomberg has learned that Treasury Secretary Janet Yellen has declined to return calls from the beleaguered head of the International Monetary Fund, Kristalina Georgieva. This indicates that the Biden administration's withholding of support for her goes beyond some of the public statements that it's made recently. Georgieva was accused earlier this month of improperly intervening in a World Bank report in her prior job there. And she's made attempts to speak with Yellen, apparently, but has failed to get through. This, according to our Bloomberg News sources. Meantime, the pandemic has thrown the world of logistics and shipping into a tailspin, spurring lengthy delivery delays and shortages. It's putting increased pressure on transportation hubs, including ports like the Port of Los Angeles. This is the nation's biggest gateway to Asia, and it is grappling with record backlogs. It's also where we find our own Ed Ludlow, who's been reporting on the situation there, and Ed joins us now. So give us the situation, Ed, from the Port of LA. Just how bad is this shipping crisis?
It's as worse as it's ever been, Emily. There are more than 60 container ships in the San Pedro Bay over my shoulder at anchor. They're waiting for a berth here in the port. They can't get in. And the more alarming statistic is that they're waiting on average 9.5 days to be able to enter the port. And when they do, as you can see behind me, they're staying there for some time. The problem is simply they can't get the containers off the ships fast enough and put them back on. There are multiple reasons for that. A labor shortage among truck drivers. There are also bottlenecks downstream. You know, America does not have the most up-to-date rail system, but LA in particular has a massive backlog at its rail terminal because that is the gateway to the rest of the country. And as you say, 40% of the country's container imports come in through the Port of Los Angeles.
And this isn't just a U.S. story, right? I mean, this is a global story that's having ripple effects around the world.
Yeah, and a big part of it is the point of origin, which is China. 7 out of 10 of the world's biggest ports are in mainland China. And simply what we're seeing from policymakers is that they will not hesitate to shut down those ports completely if they're concerned about the spread of the Delta variant. They've done it in some of the biggest ports today, and that just causes a backlog or delay in those items coming. At the same time, there's a demand question, right? You have big e-commerce giants ramping up and restocking ahead of a busy holiday season because they don't want to be left in a situation where the shelves are empty, so they're proactively trying to get as much product into the country as they can, and that's putting an already strained supply chain under more duress.
All right, Ed Ludlow at the Port of LA. We'll keep watching your reporting. For more on the supply chain crunch, we are joined now by Laura Behrens-Wu, CEO of Shippo.